The Nasdaq and the S&P 500 closed lower for the second straight week as the Wall Street rally falters. The Dow Jones, however, gains for the fourth week in the last 5. Stocks in the Asia-Pacific opened largely lower ahead of key macroeconomic data from China and Japan. The Gift Nifty is indicating a lower start to a truncated week for the Indian market. Oil edges higher on Friday, posting its 7th straight weekly gain on record demand projections. The IEA says supply cuts by Saudi Arabia and Russia could drive prices to new peaks. Brent crude holds above $86 a barrel. Industrial output growth for June comes in at a 3-month low of 3.7% as manufacturing slows. A CNBC TV18 poll sees CPI inflation for July coming in at 6.6%, significantly above 4.8% in June, largely led by a surge in food prices, which are projected to rise 9% sequentially. ONGC's numbers comfortably beat estimates in a strong first quarter. In key earnings today, ITC is expected to report a good performance, while the street is expecting sequential margin expansion from pharma major Divi's Labs. Good morning in the Mumbai News Center. I'm Sonal Bhutra. You're watching Power Breakfast. Well, it's a Monday morning, a truncated week as well. Tomorrow we are shut in terms of market because of Independence Day. But we do have a lot of domestic cues that we'll be tracking. But first up, as always, let's take a look at what the Asian markets are doing. Largely lower after a weak handover that we got from the Wall Street. In fact, the Hang Seng or the Hong Kong stocks, they are down almost 2%, more than 2%. That is because of property sector seeing a sell-off. Asian markets are overall seeing a cut right now. Taiwanese index is down 1% as well. If we look at the other indices as well, we have Straits Times, which is sitting with cuts of around 1.4%, Shanghai, which is down 1.1%, and Gift Nifty, that will come up for you on the screen because that one is indicating that the start for our own markets could be in the red. That's the implied open right now, 53 points lower if we compare it with Nifty futures. So that's the setup as far as the Asian markets are concerned. But in the U.S. markets, Wall Street ended Friday's trading session mixed, with the Dow Jones surging over 100 points, the S&P 500 was flat, and the Nasdaq Composite closed with over 0.5% cut. For the week, the S&P 500 and Nasdaq declined 0.3% and 1.9% respectively. The Dow Jones, meanwhile, advanced 0.6%. The tech-heavy Nasdaq was weighed down by a sell-off in semiconductor stocks. Meanwhile, the Dow Jones was helped by advances in Chevron and Merck. Okay, let's focus on some macro cues now. Producer prices in the U.S. rose 0.3% in the month of July, slightly higher than the 0.2% estimate. This is the highest monthly gain since January. In fact, core PPI, excluding food and energy, saw the biggest monthly increase since November 2022. CNBC's Rick Santelli gets us a wrap of the numbers.
Producer price index for the month of July. Headline number expected up 0.2 is up a little hotter, up 0.3. That's the hottest since May. Oh, excuse me. That's the hottest going all the way back to November when it was up 0.4%, up 0.4. So we want to pay particularly close attention to what the markets are doing. Rates just turned around. Strip out food and energy, also 0.1 hotter than expected, up 0.3. Strip out food, energy, and trade, exactly as expected, up 0.2. And before we go on, revisions starting to come in. Last month's headline at 0.1 is now 0, so that really makes up 0.3 look a little more exaggerated. Okay, let's go to the year-over-year numbers now. Year-over-year final demand up 0.8, 0.1 hotter than expected. Hotter than the 0.2 revision in the rearview mirror that started out as 0.1, and 0.8. 0.8 on year-over-year. It's the hottest since May when it was up 0.9. And if we look at year-over-year, ex-food and energy up 2.4%, 0.1 hotter than expected, pretty much equal to the rearview mirror, which was also 2.4, which, by the way, happened to be the lowest level since January of 21 when it was 1.9. And finally, year-over-year, ex-food, ex-energy, and ex-trade up 2.7, 0.2 hotter than expected, equal to the rearview mirror. However, last month, it was released at 2.6, now becomes 2.7. So we see that all of these metrics are a bit hotter, but the progress also has been a lot more substantial in many ways on PPI than CPI. Just consider that the 2 year-over-year numbers have 2 handles, unlike what we observed yesterday in the consumer price index.
Okay, it's time to listen into some expert opinion. Let's listen into what former PIMCO chief economist Paul McKelly and Oksana Aronoff of JP Morgan Asset Management had to make of the July inflation data and the Fed's policy trajectory.
I think the disinflationary process is very intact and durable, but we're still a long way from where the Fed wants to be. So I think the bottom line is that monetary policy is in a good place. It's restricting, inflation's coming down, but it's too early to declare that they are sufficiently restrictive, that they're in a good place, but they also want to be on the side of saying we're going to be late, not early, in declaring victory.
The Fed is not going to deliver these very aggressive cuts that were being priced in earlier in the year. And I don't think that it's going to deliver them even possibly in 2024, because, again, just because the Fed at some point in the next few months, if it's not already, will be done hiking doesn't mean that it transitions to cutting, again, in the absence of something breaking down dramatically. And I think that this is not really being priced into markets, which is that the long-run neutral rate for this economy is higher than what is currently being priced in.
Okay, all right. That is some expert opinion that is coming in, but it's time to get you the final update in our global market wrap this Monday morning. European markets ended Friday's trading session sharply lower. The three major indices, the French CAC, the German DAX and the British FTSE, closed with a cut of more than 1%. Shares of UBS rose over 4% on Friday after the Swiss lender said it will not need the government-guaranteed secure to rescue Credit Suisse. The British economy surprised markets, growing by 0.2% in the second quarter, as against the flatline expected by economists. Okay, that's a global market action, but how will these overnight cues impact our own markets? We have our research team joining in bright and early to tell you what the trade setup looks like, the stocks that are likely to be in the news, and the action from the F&O space as well. Hey guys, a very good morning to all of you. Reema, let me come across to you first up. What is the market setup looking like today?
Well, the Gift Nifty is currently down close to about 55, 60 odd points right now, and this follows weakness on Thursday and Friday. So towards the end of last week, the market started correcting and it also breached a lot of important levels. So consequently, the Nifty and the Sensex were down close to about 0.5% for the week. The cues, well, this is a holiday shortened week. So we've got a holiday tomorrow for Independence Day. But outside of that, the India CPI inflation print at 5:30 p.m. will be very crucial. And later this week, we will also get the outcome of the latest FOMC meet, which took place. ITC and Divi's Laboratory will be the big earnings to track today. In terms of flows, the FI sold 3,000 crore in the cash market. The DIs bought 500 crore on Friday. The FIs have been net sellers in the month of August to the tune of 7,500 crore. And this comes on the back of 5 consecutive months of buying. March, April, May, June, FIs were big buyers in the cash market, but in the month of August, they have been selling. U.S. markets had a pretty mixed finish. There was weakness in NASDAQ, as you pointed out. The inflation data coming out of the United States has been mixed. On one hand, the CPI print positively surprised, but the producer price, inflation print, which came out on Friday, negatively surprised the street. It came in, more than what the street was anticipating. Weak close on Europe as well as the key indices ended with a cut of close to about 1.5%. And the 10-year, US 10-year, has also inched up to levels of 4.16, and the dollar index is closer to that 103 mark. So it's a bit of a tentative situation. The Gift Nifty is currently suggesting a bit of a subdued start to begin with.
Okay, all right. Yes, that will be the move that we could see on the Nifty today, but a lot of stocks that will be on our radar as well. Abhishek has that list.
Well, to begin with, Adani Ports, they have accepted the resignation of Deloitte as their statutory auditors. Lupin, their Mandip Unit 2 facility has completed US FDA inspection and there is no observation over there. GE Power, they have received an order from Stag Energy Services Private Limited worth about 62.5 crores. So, Uno Minda, they have ARM Commission's EV systems plant in Bawal, Haryana. They are expected to start supplies by Q3 FY24. Timken India Jamshedpur plant shall remain closed between 25th of August to about 3rd of September. This is on account of low demand as well as better demand planning for productivity efficiency going ahead. Sterling and Wilson, they have got a new order worth about 1,130 crore, and this is from Gujarat Industries Power Company Limited. Back to you.
Okay, all right. Those are a lot of stocks on our radar today. But let me go across to Manglam, joining in with all the cues from the F&O space. Hey, Manglam.
Good morning. So the market has been falling all of last week. In fact, the last couple of days were particularly bad for the index, and the Nifty has been hitting lower lows. So earlier we would see some support come in around that 19,450 mark, but now it's closer to the 19,400 mark. So that's something we'll be watching out for, especially as the Gift Nifty suggests a weak opening. In fact, one of the other things that stood out on Friday's trading session was the return of the FII selling. The FIIs have sold for most of this month. And barring one or two sessions where we saw some purchase, the selling returned. In fact, the institutional net outflow was close to around 2,500 odd crores. Not just that, we've been seeing consistent selling in index futures as well. So 100 crore worth sale is what we saw on Friday too. And as a result of which the FII long exposure, which stood at 59% at the start of the series, is now down to 40%. Conversely, the short exposure is up to 60% itself. And the weakness exacerbated as the Nifty Bank broke the 50-day moving average. That has been the weak index, and that breaking an important technical level meant that we saw further weakness as well. Do we see any resistance on the way up? Yes, because a lot of call writers at important levels. So 3.5 lakh calls written by the FIIs versus just about 2 lakh puts. 19,500 call is the most active with a premium of around 75 rupees, selling you levels upwards of 19,550 to about 19,600 would see stiff resistance. Whereas on the way down, 19,350 will be an important support to watch out for, mainly because 19,400 put writers have been active as well. Were we to break that, the 50-day moving average of the Nifty comes into play, which is 19,250, and that's something we'll watch out for. In terms of stocks, the mid-cap index has been outperforming, but 9 stocks are in F&O ban, so that's something we'll have to watch out for. Also, India Cements is the one that entered the ban, whereas Canfin Homes was out of the F&O ban after a big move on Friday.
Okay, all right, guys. Thank you so much for joining us and prepping us up for the trading day ahead. Time for a short break now. When we return, we get excerpts of our conversation with the managing director of Tata Motors as the company achieves the milestone of 1 lakh electric vehicle sales in 5 years. Stay tuned for that. Welcome back. You're still tuned into Power Breakfast on CNBC TV 18. Let's move on to some macro cues now. India's industrial production fell to a 3-month low of 3.7% in June, which is much lower than the 3-month high of 5.2% reported in May. The decline was mainly due to weak growth in the manufacturing sector. However, mining and electricity sectors witnessed a considerable improvement despite the monsoon deficit. Food, textile and electronic industries have also underperformed this month. Today, however, all eyes are on the July inflation data, which will be released later this evening. According to a CNBC TV 18 poll, headline CPI is expected at 6.6% versus 4.8% in June. This is almost entirely because of the sharp spike in vegetable prices. Tomato price increase has spilled over into onions, potatoes and the entire vegetable basket. Hence, food CPI is expected at 9% versus 4.5% in the month of June. Okay, from macros, let's move on to some important earnings we are tracking today. ITC will be reporting its first quarter numbers today. Manglam is joining us with the key expectations. Manglam.
Well, as far as ITC's numbers are concerned, a large part of the key triggers have played out already. So we will be awaiting the final board nod on the demerger of their hotel business along with the numbers as well. But importantly, as far as the numbers, you are expecting a good operational performance. If you just take a look at their revenue, EBITDA, as well as the net profit, there would be a decent enough growth itself. What are the things that we need to expect? 7 to 8% growth coming by in the cigarette business volumes, 12 to 15% growth in their FMCG business. Hotels continues its run, 30 to 40 odd percent. However, on a high base and adverse regulations, we are seeing some decline in the paper business and the agri trading revenue itself. So with all of this, while the reported revenue will be absolutely flat around that 17,300 crore mark, we will see a near 13% jump in the company's EBITDA. We're looking at a number closer to 6,365 odd crores. And any further update coming in on the demerger is something we'll be watching out for as well. What does ITC's net profit in this quarter grow at? Around 15%, closer to 4,800 odd crores.
Okay, all right. So that's what we are expecting from ITC's numbers, fag end of the earnings season. So that is an important number there. Let's do one thing. We'll slip into another break. Up next, we'll get you all the cues from the commodities market. Stay tuned for that. Welcome back. You're still tuned into Power Breakfast on CNBC TV 18. It's time to talk about commodities. A lot of action there. Manisha Gupta is joining us with all the update. Hey, Manisha, good morning.
Morning, Sonal. Thank you so much for that. Well, I'll start with the crude oil prices, where we have seen 7 weeks of gains now. This week has started slightly on a weaker note here, and that is because the markets are anticipating lesser demand going forward. Well, we have seen the Chinese year-on-year crude import surge, but on a month-on-month basis, the month of July wasn't so great. August is expected to be positive. That's exactly what the IEA report also says. They say that the global demand in month of June was 103 million barrels per day, which is a record. And July wasn't so great, but in the month of August, you could be looking at these strong numbers yet again. In the meanwhile, the metals haven't done so well. We've seen the gold prices close a third week down. Zinc is trading at 3-week lows, iron ore at a 2-month lows, and the copper prices have started a new week, a month lows as well.
Okay, all right. Thank you, Manisha, for joining us with that analysis. So that's all that's happening in the commodity space. But let's stay with that. Let's now listen into what Toril Busoni of the International Energy Agency had to say on global oil demand going forward. Listen in.
We hear a lot of concerns about the macroeconomic climate, but oil demand has been recovering very strongly this year. In June, we had oil demand at an all-time high, 103 million barrels. And we're expecting further gains through August and towards the end of the year. China is driving the growth this year in global oil demand, 1.6 million barrels a day of growth from China alone, so more than 70% of the total. And we're seeing recovery in air traffic. It was expected, but and growth is slowing, of course, next year as inflation, higher interest rates are feeding into the real economy. So we're expecting only 1 million barrels a day of growth in 2024.
Okay, that is IEA's outlook on oil demand going forward. But moving on, Tata Motors recently received a key certification that will help it qualify for the Auto PLI scheme. Tata Motors Managing Director Shailesh Chandra in fact told CNBC TV 18 it expects disbursements to begin soon. He also spoke to CNBC TV 18's Parikshit Luthra on the outlook for EV sales. As we head into a break, let's listen in to what he had to say.
It's a momentous occasion for us. It's a big milestone of hitting this milestone of 1 lakh vehicles. For us, it means a lot because we started our journey 5 years back, where we took a bet on electric vehicles, where there was absolutely no readiness of the market in terms of customer comfort for this new technology, lack of charging infra, no supply base. So it was extremely difficult to really even think of doing 1 lakh, 5 years back when we started.
That indeed is a big feat, sir. So you said 5 years is what it took for 1 lakh electric vehicles. How fast could the next 1 lakh come?
As I said that the last 50,000 has come in 9 months. So I would say next 1 lakh, we should be targeting maybe a year or 14 months. That should be the timeline that we anticipate, if not faster.
You've recently received ARAI certification for domestic value addition. This was critical to receive disbursements from the PLI scheme. How important is this for Tata Motors, Mr. Chandra? And by when do you expect to start receiving the incentives under PLI?
It was a really proud moment for us that yesterday we got the certificate from ARAI, and this was a really combined effort of many people within Tata Motors and along with the suppliers, and we had to follow all the stringent guidelines that had been given in the new SOP which was released by MHI, and we are happy that with all the scrutiny and detailing that the certification agency went through, we have been able to really secure this certificate for ourselves. It was crucial because it helps us, accelerate the journey of deeper penetration of electrification going forward. It allows us to go aggressive on our investments. So it is really going to be helpful. In terms of when the the incentives will be released by the government, I think we'll be in discussion with MHI, and it should be only a matter of time, I would say.
The government is working on a FAME 3 scheme. We believe that the draft is already ready. Mr. Chandra, any expectation that you have as far as the leading electric car maker in the country goes?
You know, we have always been under active discussion on the topic of FAME with the government as and when the inputs are needed, and we have been providing that. It's a very smartly designed scheme, I would say, for different categories of, automotive categories. For cars, I think it has been only limited to the mobility services category, which is only the fleet, and therefore, for the fleet segment, it has been extremely effective. For the personal segment, this has not been extended, but if government thinks of extending that to the personal segment, I think that will accelerate the journey further for electrification of cars. In Maharashtra, we used to sell just 100 vehicles a month in the pre-incentive period, and when the incentive was introduced in Maharashtra, we started selling nearly 900,000 cars, and once the incentive was over, we still sell about 750 cars. So which means that a certain period of incentive support really helps in taking the demand to the next level.